Hey there, Lincoln here from bullacademy.org. Today was such a bad day that one of my patrons asked me who died, or at least he asked in the Discord channel at patreon.bullacademy.org, and my response was, everyone's dying. And I think that people are catching on to that fact and are panicking. And I go on to say, life is the process of dying. We live to die. And Elliot says, true, but he's waiting on his portfolios to experience that rebirth. And I said, exactly. Once you accept that you are dying and will die, you can rejoice at the fact that you will be recovered as the source of new life. This is the cycle of life. And I said all of that joking, but kind of serious in that when you're investing, you have to understand that your portfolio is going to go down. It's just going to happen. There's going to be bad years. There's going to be sometimes bad decades. That's part of the whole game. There's going to be years and decades that go very well, and there's going to be years and decades that maybe stay flat or just barely rise. But you have to play the game. This is part of the process. You have to participate. Because if you don't, the only option is that you stay poor and you get even more poor, because inflation will eat away at your purchasing power over the years at least 2% per year. And this year, it seems that it's going even higher than expected, because the actual reason that the market is so far down today, and my portfolio is down 16% in a single day, down $26,000 in a single day, is because the Federal Reserve just released their minutes saying that they're more concerned about inflation than they previously were back in December, when they just had this last meeting in the middle of December, saying that they were going to increase interest rates 3 times this year and taper their spending on bonds. But now they're thinking of doing that even faster and pretty much getting it done as soon as possible, because they're afraid that inflation is running out of control, or could run out of control. And everyone who's in the generation before, people like you and myself, if you're a millennial, they lived through the 1970s when inflation ran rampant. And in response, the Federal Reserve had to increase their interest rates, their federal fund rates, to 20%, way above what it is today, near zero, or 1%, 2%, as it's been in the last decade or two. Our parents and their parents lived through all of that. And the economy was wrecked. Jobs were lost. It was a terrible time. That's still fresh in their memories. They're 50 years old, 60 years old at this time. And they're still in the stock market. So on days like today, when they see the Federal Reserve saying, hey, we've been caught with our pants down. We thought inflation was going to be transitory, but now it's rising to 8%, 9%, way above our goal of 2%, 3%. We thought even 5 or 6% would be fine and we could recover from that. But this is going way above what we expected. And we might have to start tapering. We might have to start raising our federal funds rates, which is what all the other banks use to determine their interest rates when you go out to get a loan or a credit card or margin loan. All those banks and brokerages, they're using the federal funds rates to determine how much interest they're going to charge you. So if that goes higher, then the cost of borrowing money goes higher. And who else borrows money besides people? Businesses, growth companies, tech companies. They borrow money in order to fuel their growth, to pay for innovation. So if interest rates go higher, they're going to have to pay more for their loans, which means they won't be able to afford as much of a loan, which then means they can't reinvest into their business as much as they currently are when interest rates are near zero, or federal funds rates near zero, which means that they have less revenues and less profits potential, which ultimately means what we all care about, less growth of their revenues, profits, and so less appreciation of the value of our assets, our stocks. That's the fear. That's how all of this works. And if it gets bad enough, we could see ourselves in another recession, like 2008, right? Like 2000s, like 1970s. It could get that bad if the Federal Reserve doesn't react the right way. But on the other hand, if they react too aggressively and act too too hawkishly, they could also ruin the economy because we're still in a pandemic. Businesses still need support. People still need support. And if they go out increasing interest rates too soon and too fast or too high, businesses will be like, hey, we still need help. People aren't out going to movies, going to malls, buying things, taking trips, right? Traveling. The economy is still only partially open in the entire world economy. So if you're increasing interest rates, we can't afford to pay our workers as much anymore. We might have to cut some of them. Or we can afford to continue paying for our supply chain. So then we have more supply chain problems, which we're currently going through. So it's a very delicate balance that the Federal Reserve has to maintain. Interest rates and inflation, they're two tools that they have to leverage. When one goes up, they have to increase the other one to bring it back down and stabilize things. When one goes down, they have to bring the other one down to stabilize things. So all of this is a very hard problem to solve. And Jerome Powell is doing his best. And I personally respect Powell. He's done a pretty good job over the last year. But people who lived through the 1970s, 1980s, they know what easy money does. They know what giving all this money to these corporations and banks and institutions does. It has shown to increase the wealth gap. It has shown to increase inflation. And that leads to people having a hard time paying for their essentials, paying for a house, paying for food to eat, for their kids to eat, paying for childcare. And with schools shut down, if I can't pay for childcare and I have to stay at home and watch my kids as they're going to school over Zoom, over the computer, how am I going to go to work? How am I going to go do the job that I'm paid to do? And if I can't do that job, how will I get the money to eat? And then the cycle continues. And then the employers have to figure out, we don't have enough employees to fulfill our demand. And potentially, once you get to that point, potentially it gets even worse, where they have to start letting people go because they're not fulfilling demand. And because they're not fulfilling demand, they're not making money. And because they have to let people go, people have less money to spend. And when they have less money to spend, they can't buy as many things. And so now the businesses have to lower their cost of their goods on the market to sell them. And if they do that, they make less money, which means they can afford to pay less people, which means they have to let more people go. And then we get into a deflationary spiral. And that's what Cathie Wood actually says is the greatest risk right now. Or at least she said that last year. I'm not sure her stance is anymore. But that deflationary spiral is worse than the inflationary spiral. Because deflation causes people to hold on to their money because they don't have a job. And they believe that that money is going to be worth more tomorrow because that's what deflation is. Inflation makes your money worth less tomorrow. Deflation makes it worth more tomorrow, which means that you're going to hold on to it because you believe that instead of getting one loaf of bread today, I'll wait until next week. We can deal with it. We'll hurt a little bit. We'll starve a little bit. We'll be hungry. But if we wait until next week, we can afford 2 loaves of bread. Or we can afford a bigger TV, bigger house, a bigger car, whatever, faster car, right? So then deflation continues, and that's what we saw in the Great Depression. So there's so much that can go wrong. It's incredibly, it's phenomenal how delicate our system is, the economy, right? You have to do everything perfectly within reason, in a certain degree, right? You only have a tiny margin for error. If you go too hawkish, you get into a deflationary spiral. If you don't go hawkish enough, you get into an inflationary spiral. But you have to go just right, right? The Goldilocks. You have to get it just right. You have to get inflation. You have to get interest rates just right. And that's what the Federal Reserve is tasked with doing. That's what they signed up to do, right? We didn't always have the Federal Reserve. They came in to say, hey, we can solve your problems. And now that's their job, to try to balance all of this. And so people understanding that it's a very delicate balance to maintain, and that at any moment we could go back to the 1970s days or 1921 with deflation if we don't act in the right way, if our Federal Reserve acts too hawkishly. When these people who have lived through those days and had grandparents who told them about the days of 1921 and around that time and the decade that followed, they get very afraid. They're the ones with all the money today. They're the boomers, right? They have all the money. They control the stock market. So when they get afraid, they affect the rest of us because they move the stock market a lot more than we millennials and Gen Zers do. Yeah, they're my mom, maybe your mom and dad, right? And their grandparents. They lived through some very dark times. But what they forget is that they got through it. That we're here now. We've had prosperous times. Our economy has been extremely prosperous. It's been doing so well. The dollar is up over the years, 6%. The only reason we're in this mess is because a black swan event with the COVID-19 came out of nowhere. Well, some people say somewhere, but we won't get into that right now. Anyway, they forget that part of life, or the process of life, is the process of dying, right? Every day you're dying more and more. But you have to remember that after death, the cycle continues. You're recovered and used for new life. And so that's how I look at the stock market. If you can get through the death, you can get through the bad times when your portfolio is dying, like mine was today, down 16%. If you can get through those dark days, you can survive and get to benefit from the days that come after, the good days, where your portfolio comes back up, where your companies that were affected on the stock market, but we're still doing well in the actual market with customers still making money, still increasing their revenues and profit margins and going towards profitability, they're still doing well. And one day, if they're strong today, hopefully, if you've done the right research and believe that they're going to continue to be here in 10 years, in 20 years, then if you can get to that day, you will benefit from the appreciation of the value of that asset, which is what we always say on this channel. That's why you invest for the long term. If you're focused on the short term, yes, you're going to freak out during these times. You're going to sell all your portfolio positions. You're going to sell the wrong ones because you're thinking, oh, I had a plan to have this go to the moon next month, but it's not looking like it's going to happen. So I'm going to cut my losses now and get out. Save myself some more losses because we're so afraid of losing. We're more afraid of losing than we are happy and excited about winning. That's just in our psychology. So if we're thinking short term and we see loss coming in the near term, we're going to try to avert that as much as possible. And on these days, it's very easy to fall into that panic and forget that there's more days ahead. That our economy goes through a cycle, right? There's cycles in our economy. It goes up and down, right? That's how it's designed. That's how it works. It's very fragile, but it is a cycle. So these bad days in the short term, yeah, if you're focused on the short term, you're gonna lose lots of money if you sell your portfolio, your stocks. But if you hold on, if you set yourself up to survive, if you've been invested for the long term, continuously putting in money every paycheck, right, into companies that you believe in, understand, and plan to hold for the long term, into index funds because you don't want to pick your own stocks, ETFs, let somebody else handle that, let the broad market handle that for you, and you're focused on 5, 10, 20, 30 years ahead, you'll be fine. You'll get through it. Even if you lose a decade, that's a risk. We could have a decade, like I said earlier, that doesn't go well, that we barely go up, or we go down a little bit, or we stay flat. That can happen. But even if we stay flat, your money is still there. It isn't going anywhere. The only time you lose really is if you sell, and you usually only sell if you didn't plan well. If you plan for a short-term gain to go to the moon, but the rocket ship breaks or gets shot down by inflation and interest rates rising, that's when you lose. So plan for the long term. Like I said in our video from last weekend, when you plan for the short term, you don't have the option to readjust mid-flight, right? You're already in the air. You're already dead set on that target for the short term. You don't have the option of the long-term thinking. So when things go wrong, you're already heading to disaster. There's no turning back. But when you focus on the long term, you have the option of looking at short term and say, okay, things are bad. I could keep holding. Or you can say, okay, things are going very well. They're going way too well. Maybe I should take some of my chips off the table. I should sell some of this or sell all of it because I don't believe that it can get any better from here. You have that option. I don't choose to do that often, but there are times when your stocks go up way too high, way too fast, and you think, okay, this is up 25x, 100x in a year. I don't see this being sustainable. I'm going to take it off and find a better investment for the longer term. So you have that option. You can always think about the short term when you're focused on the long term, when you have a plan for the long term. But on the short term, you don't have the option of looking in the bigger picture. So that's why we always say focus on the long term, because these days do happen. And when they happen and you're down 16% like myself today, you don't want to be the person who has to sell because everyone else is selling, because you're afraid that it's going to get even worse. You want to have the option to go back into the market and say, hey, see you guys. I don't know why you're running away, but hey, I'm going to stay here. All these sales, I'm going to buy those sales that you guys are leaving on the table, that you're giving me because you're selling all your belongings for a discount, for 16% less than it was worth yesterday. Thanks. I'll see you guys later. Hey, cashier, let me buy that. Let me buy SoFi. Let me buy Cloudflare. Right? Let me buy Tattoo Chef. Let me buy Beyond Meat. Let me buy Nvidia. Let me buy Tesla. Whatever you're interested in, you get to buy at a discount. That's the beauty of days like today. Only if you have a long-term view. The people running away, those guys thought they were going to the moon. They thought that they knew how to predict the future. They didn't know that time in the market beats timing the market. No one ever told them that for some reason. All they knew was to the moon and the GameStops and the AMCs and the stock options, trying to predict what's going to happen in the next week, next 2 weeks, next day sometimes. And then they get caught with their pants down when the Federal Reserve says, hey, we got caught with our pants down. We're sorry. We're going to have to raise interest rates earlier than we expected and maybe even higher. But in us sitting over here, focused on the long term, we're going to say, hey, Federal Reserve, how much you going to raise the interest rates? To 1%? A little bit above 1%? Maybe less than 1%? We're at 0% right now? So you're going to increase it to 1%? Oh, we've been here before. Just a few years ago, we were at 1%. We were at 2%, 3%, 5%, whatever it was in the last 2 decades. We've seen Tesla grow. We've seen Amazon, Google, Facebook, Square. We've seen so many companies, growth companies, excel throughout those times when interest rates were higher than they are now and higher than you are telling us you're going to raise it to this year. So what's the issue? Everyone's saying, oh, growth stocks are going to grow less because the interest rates are going to go up to 1% or 2% or 3%. But we just saw what happened with Google and Amazon. We've seen Apple go to a $3 trillion. They've, 10x'd since Steve Jobs died in 2011 when Tim Cook took over? They've 10x'd during times when interest rates were higher than they are now. So what is the issue? Tell me, people, what is the issue here? Why are you running away? You don't like free money? Why are they running? Why is everyone on TV telling me that growth stocks are dead? Here's why. Because the people who are saying that are the people who lived through the 1970s, and all they remember is the bad days, the dark days. They forget the prosperous decades that followed, that we're still in. So I'll get off my preaching right now and say, hey, I bought some more stocks today. I bought some more net. I'm looking into CRISPR. I'll talk more about that this week, maybe next week. But CRISPR is very exciting. Sickle cell. They're doing amazing things. Companies are fundamentally sound because they actually produce value for our economy, for the people in the market. That's why I feel so confident investing in companies because they have intrinsic value. They actually produce goods. Unlike other asset classes that are just speculation. I bought a dip on stocks because they are worth something. I know what they're worth. I don't know what Bitcoin is worth because it's only worth what everyone else says is worth. And as soon as things turn bad, they run away. That's human psychology. So I'm not going to put my trust in people's minds, people's psychology, people who are so fragile that they run away at the sight of sales. Because I don't know what that's going to go down to. If I buy a dip, it's going to just keep dipping. And it could dip infinitely to zero. Because there's no lower bound. There's absolutely no lower bound. But with stocks, with companies, there is a lower bound. Sure, it's zero. But that's only if they absolutely fail at what they're doing. Or we have bigger problems to deal with. Like the government completely failing and the country's dead. Or there's a nuclear bomb. Right? Another war. Even during the wars, we didn't go to zero. Companies continue to survive. Actually, today, there are companies who make money from war. Look at the defense contractors in the United States. They made off with billions and billions and trillions of dollars over the decades that we were in Afghanistan. It's a whole industry. So things have to go extremely wrong for great companies, productive companies, valuable companies that produce actual utility and goods for the economy and the people in it to go to zero. So I don't understand. Well, no, I do understand, but I'm not gonna be here overreacting, selling all my shares because the Federal Reserve says, hey, we're gonna increase interest rates to 1% faster than we thought we were going to, and we caught ourselves with our pens down. So we're sorry, but hey, and jobs, we're creating more jobs than expected. But we're still in a pandemic, so we don't know what we're going to do yet. But, right, there's so many variables at play here. I can't be here freaking out by every single metric that is moved up and down every single month. That's why I focus on the long term. It's so much easier. I guess I'm lazy, but that's so much easier for me. I prefer to just sit back, invest, buy the dips consistently, believe in the companies because they actually produce goods and utility for the world. And myself, I actually use the companies that I invest in. I know them, right? I understand them. I believe in them, and I plan to hold for the long term. That's the bull mentality. We've said that since we started. I say it because I believe it, right? So that's what I have to say. But I'm excited for this year still. Things are going well. I'm happy. I don't really see what the big problem is, unless of course we dive into a deep recession. But that's unlikely. We might get to a recession like 2008, 2007, 9, whatever, or 2000s. But if you're focused on long term, it doesn't really matter. Bad years will come. Good years will come. But if you look at the stock market graph, I guess it's this way. I keep forgetting. Up and to the right. That's where we've been. Up and to the right. Through World War I, 2, 3, 4, 5. All of them. All the different wars that have come. Right? All the different catastrophes. Leaving the gold standard. The bombs, the 9/11s, the dot-com bubbles, all the hysteria, the financial frauds. We've been through all of that. And up and to the right. Over the long term, yes. Again, we're gonna have bad years. There's a chance that you could go bankrupt. If you don't plan right, but yeah, it's a chance. But that's not the worst thing that can happen. You have bigger problems than that. So, and just to be clear, it's a very low chance that you go bankrupt. Investing in the stock market is extremely unlikely. I'm just saying that because it is a possibility if things go extremely poorly and you're investing the wrong way and being hyper risky. I fit that bill. I am taking extreme risk that I probably shouldn't be taking, but that's just me. I'm pretty young. I'll recover. I'll figure it out if anything goes wrong. Don't follow my lead on this one because it's definitely way too risky for most people. But yeah, but for most people, who are investing for the long term, investing in an index fund, investing in sound companies that are producing great value, and are somewhat understanding of the swings and the cycles of our economy and our markets, you'll be fine, right? Just keep investing for the long term. Invest a portion of your salary every month. Invest only what you don't need for the next year or 2 or 5 years, right? 10 years. If you don't need the money, you don't need it. If it goes away for some time, takes a little vacation to Maui or whatever, Hawaii, doesn't come back for 5-10 years, you say you didn't need it, so you should be fine, unless things go extremely wrong. So anyway, that's how I feel about this awful day that we're all seeing. That is actually good, because if you have money, you can buy up the dips and lower your cost basis for your positions, which means that you have greater upside potential. All of that, right? That's all great stuff if you're focused on the long term. So I hope you enjoyed the video, and I appreciate you being here and watching this video to the end. I know it was long, probably much longer than I expected it to be, but I do thank you. And if you did enjoy it, please don't forget to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts. Let me know what you're feeling, how you're investing. Are you buying more shares today? And how long you're planning to hold for long term, right? Or if you're one of the people who are running away, let me know why. I would love to hear from you. I love to hear what your fears are for the year, because I love to know both sides of the story so I can make better investment decisions. So comment below. Your engagement really helps this channel grow and helps us keep going, because if you don't engage, YouTube won't recommend my videos, and I can't keep making videos that you guys aren't enjoying. So if you want to keep us here for the long term and keep these videos coming so we can all continue to learn and grow together, like, share with one friend, help your friend. They're having a bad day too, probably. Send this video to them. Let them know that things are fine, right? And they likely will be fine over the long term. You doing that, you're doing your part. And of course, if you want to support us financially, like our patrons at patreon.boacademy.org, who support this channel, help me brainstorm new video ideas, and help me afford to bring on more team members and grow the channel and produce more videos, then you can join us over at patreon.boacademy.org, and you'll get to engage on Discord channel where we share knowledge and discuss the stock market in real time every day by sharing news, rumors, and new investment ideas, so we can all do our own research and then come back together and collaborate. We got into CCIV Lucid Motors early, SoFi, ChargePoint, and so many others early because of that collaboration. So if you're interested in all of that, I hope to see you over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again, and have a great day.